The Fed just announced a major policy announcement which is going to impact the future value of your money and investments and the entire economy as a whole. This can either be a good or a bad news for you. It is going to affect the stock market, savings of people, real estate, and entire economy as a whole in many different ways. So I recommend you guys to watch this till the very end because the information I'm going to share in the next 10 minutes can potentially save you a lot of money. If you like the information, just make sure you press the like button and don't forget to subscribe. Hi, my name is Sunny and welcome to my channel Sunnysnippets. Here, I try to declutter some of the latest news, make it simple to understand so that my audience is well informed. Based on the results during the last recovery, the policymakers are thinking not to open up the monetary policy too early. It means the Fed is attempting to push the inflation rate above 2%, which was the target inflation rate for the Fed for a very long time. With the possibility of another prolonged period of low inflation, the Fed is signaling a policy change. This means the Fed is not going to increase the interest rates until they see a substantial movement in inflation. The implications for financial markets is the Fed is expected to hold a policy of low interest rates for a very long time until the inflation remains under 2%. The Fed chair said it is going to use all the tools at its disposal to increase the employment and keep the inflation rate low. They are making some of the most important changes in a decade where they might keep interest rates low for a very long period of time to fuel jobs and stable inflation. The Fed has a dual mandate of maintaining stable prices and maximum employment. It used to do this by controlling the Fed funds rate. But with changing times, the central bank realized it has less scope to stimulate growth by simply cutting the federal funds rate. Under the new aggressive strategy by the Fed, the US central bank will achieve inflation averaging 2% over time. It means offsetting below -2% periods with higher inflation for some time to ensure maximum level of employment in the US. It also means when the inflation is very low, to offset that, the Fed is willing to accept higher inflation on certain times so that the average inflation over a longer period is close to 2%. This is a sea change from the earlier policy where the inflation target at any time was 2%. This chart shows the inflation in the US from 1914 to 2020. It has been a very low and steady for the last 40 years, except during 1980s when there was a big increase in inflation. For a very long time, the inflation has been very low in the US, but it's worth knowing its effects on a common man. The single most effect of inflation is that it erodes the purchasing power due to rising prices in the economy. Within living memory, the average price of a cup of coffee was a dime and today it is close to $2. As you can see from the graph, the purchasing power of $100 in 1947 is reduced over a period of time. It means with time, the dollar buys you fewer goods and services because of inflation. Holding cash over time loses its value because of inflation. So, this declining purchasing power encourages people to buy now rather than later. These purchases can be stocks, gold, real estate, etc. Over long term, stocks can be the best hedge against inflation if chosen wisely. As an example, a share of Apple was $29 in 1980 and in 2018 the same share should be worth over $7,000 adjusted for dividends and stock splits. On the other hand, if you keep that $29 in cash over the same period, its purchasing power would have fallen to almost $10, which is a depreciation of 65%. The new policy means Americans can enjoy a very low borrowing cost for longer periods even when the economy recovers from COVID-19 shutdowns. This results in lower cost of borrowing for home, auto loans, credit cards, student loans, etc. With interest rates to stay low for a while, investors move their money from low-yielding bonds to stocks. This has enabled S&P 500 index to reach new record highs because of new influx of money looking for better returns in low interest environment. This has encouraged the investors into stocks and other relatively riskier assets, thus leading to a risk of creating a stock market bubble. This is my take where I have tried to declutter the effects of the new Fed policy to have an average inflation rate of 2% over longer term on savers, people with fixed incomes, homeowners, and economy in general. If you have found value in the content that I make, please help me and my channel by subscribing, liking, and share it. Press the notification button to get notified about the latest videos that I make. Thanks for watching. See you next time on your channel, Sunnysnippets.